What's up, everyone? You made it to Lab 5. Question 1, we're going to be discussing capital cost allowance. This is a topic that's very difficult for you to escape if you go into any sort of business that involves numbers. Okay, you might think, hey, I'm not going to be an accountant, I'm going to be a finance person. Well, you still need to understand capital cost allowance. And if you want to be an accountant, you're going to see capital cost allowance comes up again and again. It'll come up a little bit in tax 2, it comes up in advanced tax courses, it comes up in your finance courses when you start calculating the present value of something known as the tax shield. And that will also come up in any sort of business valuation course that you do. Now, while the topic is somewhat similar to the idea of accounting amortization or depreciation, it is ultimately quite different. So it's an important concept to understand. Anyways, let's get to it. You've got questions, we've got answers. Let's go! Question 1 reads as follows. George Tennis started a new proprietorship on September 1st, 2020. That's important information. It being a new proprietorship beginning partway through the year is an indication to you that you are probably going to be dealing with a short fiscal year. Let's continue on. It's offering microchip design services. His first capital acquisition was a Class 8 photocopier, which he purchased on December 1st, 2020 for a total cost of $50,000. The required. Calculate George's maximum CCA deduction for 2020 and indicate the opening UCC, that's undepreciated capital cost, balance on January 1st, 2021, assuming the following. The required has two scenarios. Scenario 1, the asset purchase is not eligible for the accelerated investment incentive. Or requirement 2, the asset purchase is eligible for the accelerated investment incentive, abbreviated as ACCII. A quick word on the accelerated investment incentive. This is a relatively new area of tax in Canada. As of this recording, the dates that this is in effect for are November 21st, 2018 through to December 31st, 2023. The accelerated investment incentive was a response by the Canadian federal government to a significant reduction in corporate taxes down south in the US. The underlying idea was the new approach should provide an incentive for businesses to make additional capital expenditures after November 20th, 2018. For most assets, the accelerated investment incentive removes the half-year rule, and it replaces it with a 50% increase in the base for calculating the amount of CCA that can be deducted. This question will allow us to contrast the two different approaches, the old half-year rule and the newer accelerated investment incentive rule. Now let's take a look at the question again. It does say that the photocopier, let's highlight over here, is a Class 8. See, we told you the class. Class 8 photocopier, but we haven't told you what percentage is used for Class 8. For that, you need to go to the Income Tax Act. So why don't you take a moment and go to Schedule 2 of the Income Tax Act and look up Class 8. If you get to Class 8 in the Income Tax Act, you will see that it's 20%. Let's go back to the question. You'll note that I've already created T accounts for the UCC balance for a Class 8 asset, and this will be at 20%. We'll start off with requirement 1, where the asset purchase is not eligible for the accelerated investment incentive. Our opening UCC balance is going to be 0 because this is the proprietorship's first year of business. The additions for the year are 50,000 and the dispositions for the period are 0. That gives us UCC at December 31 of 50,000, which is the opening balance plus our net additions. This would be a good time for you to remember or take note of the fact that technically CCA, capital cost allowance, is taken at midnight on December 31st, at the very end of the year. So the ending UCC balance for a year is going to be different from the beginning or opening UCC balance of the following year. I'll show you what I mean in a second. What do we do after we get to this point? Well, it's time to calculate CCA, or our capital cost allowance. I'll do the calculation below, so let's make a note. Let's call it note 1, and let's do it down here. So to calculate CCA, we start off with the opening balance of the account, and then to that we add 1/2 of the net additions. And that would have been 50,000 subtract our dispositions, which were 0, and all of that would get multiplied by 20%. Now remember, we have a short fiscal year. There were 122 days in the fiscal year, and we would divide that by 365 days in a year. And that will yield our CCA for the year. Let me just emphasize that again. We're using 122 over 365 because the proprietorship started on September 1st. So from September 1st to the end of the year is 122 days. Even though the photocopier itself wasn't purchased until December 1st of the year. The fact that the photocopier was not in use for the full year, that's what the half-year rule takes care of. So whenever an asset is acquired, really the most CCA you can take on it is 1/2, 50% of a typical year under the half-year rule. This proration here has nothing to do with the fact that the asset was purchased during the year. It's got everything to do with the fact that the asset was purchased in a short fiscal year. If we do this math, we end up getting 1,671. And so we'll plug that in here. This will create UCC at January 1st of the following year, which will be different from the UCC balance on December 31st due to the capital cost allowance. And here we get $48,329. We could do that all over again, except this time we'll do it assuming that the asset purchased, the photocopier that is, let's assume that it is eligible for the accelerated investment incentive. A lot of it's going to look the same. I'm just going to copy and paste a few things. Our opening UCC is still 0. This is the first year of business for the proprietorship. And our additions are 50,000 and our dispositions were 0 during the period. So our undepreciated capital cost on December 31st is going to be $50,000. Really what we need to do now is calculate the capital cost allowance. And I think I'll just put a note down here to help us keep track of our calculation. Essentially, the Accelerated Investment Initiative allows a 50% increase in the base for calculating the amount of CCA that can be deducted. So we can take our opening balance and we can add our net additions, 50,000 in additions, subtract 0 in dispositions. And to that we can add 1/2 of our net additions. That would be the 50% increase in our base. All of that would be multiplied by 20%. And then, because this is a short fiscal year, we would prorate for the number of days in the fiscal year. If we do all of that, we should get $5,014 rounded. Which leaves us with an undepreciated capital cost of $44,986 on January 1st. Once again, I'll point out that the UCC on January 1st is different from the UCC on December 31st because in tax it is assumed that the capital cost allowance is subtracted at midnight or at the very, very end of the day, right? Which leads to a different opening balance the following year. Finally, we can compare and we can see that under the accelerated investment incentive, it's accelerated, right? So the capital cost allowance of 5,014 is more than what you'll see under the old half year rule of 1,671. So over the life of both of these assets, assuming that they are both fully depleted or capital cost allowance is taken on the full amounts over their life, the total amount of CCA over their life will be the same, but as you can see, you'll be taking CCA faster under the accelerated investment incentive than you would under the old half-year rule. Hey, I hope you found that helpful. Until next time, thanks for watching.